Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the Equity Mates community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Always excited, always keen to learn. And God, we're going to learn a lot today.
Big time.
We are speaking to Seb Mullins. He's the head of multi-asset investing at Schroders. Fun fact about Schroders, they manage the king's money.
Yeah, the royal money over in the UK.
Yeah.
Big name in the UK.
Don't think Sebastian does, but...
You never know.
But look, I think the context for this interview is just we have lived through some head-spinning times, really just to start 2025.
Yeah, in the last month.
It's impossible to keep up with the economic news that's coming out, the geopolitical news that then has flow-on effects to the economy. Obviously, a lot of it starts with the new president.
Getting whiplash.
Yeah, but that's obviously not all that is going on. And so why we wanted to speak to Seb is he's a multi-asset manager at Schroders, which means that he invests across asset classes and globally as well. So if we wanted to try and understand how we should think about everything as investors, he's the kind of investor we want to speak to.
He's the guy. So with Seb today, we're going to cover the macro and what's going on across the globe, and then more importantly, how that actually translates into an investing strategy across all of the different asset classes, pick his brains on portfolio construction, and then understand from a product point of view how Schroders are bringing their funds to market in order to help us as retail investors get access to some of these investing opportunities.
Yeah, and we should just say before we get into it, a massive thank you to Schroders for sponsoring this episode. The support of partners like Schroders helps us keep all of our content free, so we do appreciate the support.
Without further ado, let's do it. Seb, welcome to Equity Mates.
Thanks for having me.
So 2025, it's been a bit of a whirlwind start. Amongst all of the noise that's been going on, what have been the most important macro stories for us as investors?
Well, I think the tectonic shift that's going on beneath the surface has really been inflation. So you can talk about that this year, probably for the next 10 years. And that's been a big shift because most investors haven't really been used to it. If you think about it, since the GFC 2008 onwards, very low inflation, very low interest rates, very low macroeconomic volatility. So while the reasons we had inflation recently, COVID, supply chains, Ukraine war, you name it, have all dissipated, the genie's really out of the bottle. And the reason I call it a tectonic shift, is because effectively the last, say, couple of decades, a lot of the reasons we had disinflation are sort of turning the other direction. So I don't want to spook everyone saying 1970s or something like that, but some of these big picture themes are starting to reverse. So, people say regime shift lightly, but this is really a regime shift.
So, Seb, you're saying the one rate cut that we got it wasn't us solving inflation?
No, definitely not. But I mean, you think about sort of cyclical inflation, structural inflation, right? So if you think about the US, they struggled for a decade and a half to get inflation up to 2%. Within the next decade, they're going to struggle to get it down towards 2%. And the reason I say that, talking about news and everything else, but these big picture themes that are changing, globalizations went to one extreme, now it's coming back. You had COVID sort of illuminate that. You had just-in-time manufacturing, now it's like just in case. We need some redundancies just in case we can't get our goods from overseas. That's in the corporate's interest because you can't make money if you can't sell things they don't have. And it's also in, I guess, government's interest because of national security. We had no PPE gear in Australia because it came from China. China shut down. So you're seeing this move away from this sort of mass specialization, or I should say niches like Taiwan makes all the chips. That's really cheap, but it's a problem if it's next to a superpower that might be an ally or an enemy. So moving it to, say, the US is a fiscal imperative, a government imperative, but they're over budget, the chips aren't as good. And when you pay more for something that's worse, that's inflation. You've seen society say, enough's enough. You've had wage share collapse since the 70s, profit share rise to all-time highs. that leads to populist governments coming in. So Trump shouldn't be surprised when that's the backdrop. We haven't gone to air before the election, so we haven't seen what happened in Germany, but AfD is looking more and more likely. You had Le Pen getting more and more likely. This happens because of inflation. This happens because you have these regime shifts when people say enough's enough. So that backdrop is a really big change, I think, to the macroeconomic landscape and investing as a whole.
It's kind of scary now that you say.
Well, there's some good news there. I mean, if you think about what that means for an investor, it's more exciting, one thing.
Well, I mean, that we're going to talk about that in detail throughout this, but maybe just at a headline level, like why is that exciting for investors?
Well, think about it. When you have low inflation, from a top-down asset allocation perspective, equity bond correlation, everyone expects it to be negative. That's why you have a 60-40 portfolio, a balanced fund. Historically, that's not been the case. Last 100 years, on average, has been positive. So if you think higher inflation, that dynamic breaks down. You have to be more dynamic with your asset allocation, or think harder about what you put in those buckets. When it comes to being an equity investor, higher inflation, higher cost of capital, what companies can survive, strong balance sheets, who can pass the costs on to their consumers, who has pricing power, who has a good moat, who's going to win or lose from industrial policy or these trade wars going on. Being active matters again. So it's a more interesting time to invest. And I think the big shift is going to be, you've had fiscal policy being really tight the last few decades, monetary policy being very loose. That's going to flip 180 now. So strong fiscal policy and central banks around the world continually tapping the brake to bring inflation back down. So I think to finalize that, we've come from an age of abundance where money was cheap, zero interest rates, negative interest rates. You've had cheap commodities. You can just take whatever you want pretty freely because global societies are all friends at the time, and now not so. If you think about Greenland, why does Trump want to invade Greenland? Sounds stupid, but rare earths are there. China currently controls most of them. It kind of makes sense in that geopolitical shift we're seeing.
Yeah.
And people are asking for higher wages now. You've seen more industrial action since COVID than the decade before. So no longer having cheap commodities, cheap energy, cheap money, or cheap labor means we're going to an age of scarcity. So higher inflation, more winners and losers, more volatility, but more opportunities.
Yeah, it is interesting, isn't it? Now, we want to zoom in on the US because at the start of the year, you wrote that the story of the year in 2025 would be a continuation of US exceptionalism. We're 6 weeks into the year, but it feels like everything has changed. Is that still your view?
In terms of economics, yes. Because if you think about the US, we can talk about Trump later, but you've seen a very, very strong US growth outlook, right? You've had, let's call it 2.5% to 3% GDP growth for the past year or two, expected to continue next 2 years, above trend growth. That's been driven by consumption. So people spending their money to buy goods and services, which is far healthier than, say, here where it's been government spending effectively. So you've had good consumption. Real wage growth is still positive in the US, so they can continue to consume. Unemployment rate's very low at 4%. We don't see any reasons why unemployment should rise. Our recession models are all turned off. You normally fire people when your margins are getting squeezed. That's not happening. US corporates are doing fantastically well. US consumer also had delevered after the GFC. Again, unlike here, debt to GDP is very down. Household debt to GDP is down. Household debt to net wealth is all-time lows, meaning their wealth is higher than their debt. The amount of money they pay on their debt divided by their income, all-time lows for 40 years. So they can actually re-lever if they choose to. We're seeing banks ease lending standards. Trump's talking about bank deregulation. That could start a whole new credit cycle, which is a tailwind. Now, that might cause a GFC in 10 years' time, but for now, it's another positive for the US economy. PMIs are improving, manufacturing improvement. I can go on and on and on.
Yeah.
So US economy very strong. Trump, America first, turbocharges that. So American exceptionalism probably here to stay. The rest of the world before Trump was kind of limping out of a downturn. Very weak growth here, Europe, China, terrible stories coming out of there. It was looking like things are starting to improve, and they probably will continue to improve. But as they're getting off their feet, Trump's coming along to whack them with a trade war. So for us, more volatility there, but ultimately US exceptionalism should win out in that environment.
Let's just hold on Europe and the UK for a minute, because you're right. Like, they've been boring, laggards. Not boring. Like, there's some interesting companies, but index-wise, like the FTSE 100 in the UK and the Stoxx 600 in Europe haven't been anything to write home about. But you look at them for this year, and the Stoxx 600's up like 9%. The FTSE's up, 6%. the conversation around, these markets is like Britain's a basket case economically and Europe's getting whacked by Trump. How do you put those two together, like the media narrative around these regions and the economic performance?
Well, say first of all, zoom out. So even after the recent rally, still massively underperforming the US. Positioning was very, very underweight those countries. And there's been a bit of a short squeeze going on where people were very underweight Europe, now they're quite overweight. There's a new piece I think Bank of America put out saying falling in love with Europe again, which usually is the top, right? So that's been doing really well. If you go beneath the surface on the Euro stocks, it's been Germany, it's been SAP. So if you're thinking, I can't buy the Mag 7 in my European portfolio, I'll buy this guy, it's the same thing. That's pushed the market higher. Now, again, if everyone's so negative and underweight, eventually that improves. And the economy is improving. So you think Europe and the rest of the world can play catch up this year, but with a lot of volatility, because every time they stand up, Trump's going to knock them back down again. Now, the UK is a basket case. The index, though, might get in trouble for saying this, it's like one big sin stock. Oil and gas companies, tobacco companies, alcohol companies. So people haven't been buying those for whatever reason. But what do companies like that typically do? They return capital to shareholders. So having a re-rating is unlikely, but higher dividends, higher buybacks. The UK now has more buybacks as a percent of its distribution to investors than the US.
Oh, wow.
So the UK is becoming a buyback hub because of those dynamics. Not re-rating, but returning capital to shareholders.
Now, Seb, you recently wrote a piece called Make Volatility Great Again with reference to how Trump's policies will impact markets. I guess with reference to some of the specific policies that we're seeing coming out now and a lot of the executive orders, how do you see the Trump 2.0 administration really impacting the macro environment?
Well, I think first of all, volatility is back because Trump's unpredictable.
Yeah.
Like we were saying offline, every day he tweets, I shouldn't say tweets, sorry, he posts on Truth Social.
Yes.
Some half-truths or non-truths. But he comes out with new policies every day and it takes us, and blindsides a few of us, right? So volatility is back in terms of his own thinking. So I don't think he's figured it out quite yet. And then the market's reaction to that. But if you take him at his pure core of his policies, there are two main camps that he's trying to do. One is pro-growth. Tax cuts, deregulation, that's all great for growth and for equity markets. The other side is protectionist policies, tariffs, immigration. It's focusing on those two. Those are more inflationary, right? So the joke I have on the first camp is you only benefit from tax cuts if you pay tax. So Google, Mag 7, they don't pay that much tax in America. So the smaller companies, the more economically sensitive companies, they should benefit from that, not the Mag 7. But ultimately, if you pay people more, they have more to spend. And corporates pay less tax, they have more to distribute in earnings. Deregulation, banking deregulation, we talked about consumers, they can relever, drill baby drill, deregulate energy companies. All that's great for growth and earnings. Societally, we talk about a different story, but in terms of earnings and growth, fantastic. On the protectionist side, obviously tariffs can increase inflation. One caveat there is though, it's on the import price, not the total price. So if you import a good, you have your own overheads, your marketing costs, your own margin at the retail side of the end. So only about 40% of the good would be tariffed in that sense, on average. Yeah. There's also natural equalizers, currency devaluation, say hypothetically Chinese yuan falls, US dollar rallies, offset some of it. You take the made in China sticker off, whack in made in Vietnam. Some rerouting can help. And ultimately, either the exporter in China or the importer in America can see their margins get squeezed. So it doesn't all flow through to the end consumer, but somewhere someone hurts. Yeah. So that's inflationary or at least negative to either China or the importers. Immigration, there's less natural balances there. Now, I don't think he can physically deport 30 million people. We shall see. But what he definitely has done is limit immigration. Now, if you think about that, wage growth has fallen because new people have joined the workforce. You take them away, unemployment naturally goes down, wage growth goes up. Great for consumers, but that leads to inflation. Now you could say Dodge might fire a bunch of government workers, but I don't think, someone in the Department of Education is going to go pick fruit tomorrow. But there might be some rebalancing occurring there. But ultimately, protectionist policies pro-inflation, growth policies pro-growth. The joke we have is, will growth trump inflation? So I think the timing mismatch, one is executive order, other tax cuts is through Congress. As the market digests which is coming and when, and which is actually the final policy, not just rhetoric, you'll see volatility. So for us, strap yourself in. But again, volatility equals opportunity, so stay nimble.
When you ask, will growth trump inflation? Like, isn't there a world where we get heaps of economic growth and inflation as well? And so, like, from a nominal point of view, like, the numbers are just off the charts. From a real point of view, we're still seeing underlying growth, but it's just like a really overheated economy.
Exactly. So that's why we think then the Fed's sort of on pause, right? If anything, they might even have to hike next year. So that causes new types of volatility. That might cause, again, interest rates to go up. So then cost of capital to go up, squeezes consumers, squeezes corporates, could lead to a slowdown. So it's one of those things where higher inflation leads to potentially slower economic growth. But for us, again, we're not saying going back to 1970s inflation or even the 8-9% we saw in the US just 2 years ago, right? If we're having 3% growth and 3% inflation, that's fantastic for equities. That 6% nominal growth, that's going to deliver in earnings. Winners and losers again, but that's not too bad. But I think the market trying to digest what's coming first and what's not will cause volatility. Everyone priced in the positives of Trump. Day 2, he hasn't tariffed China. There's no more tariffs. It's like, come on. He came to power based on those policies. He's going to do them. He just has a sore wrist from signing all those executive orders, right? He needs to wait a few days. And now we're having the tariff talk again. So as the market digests those two, I think there's going to be volatility, but ultimately U.S. growth will be strong. Rest of the world probably will suffer, but improve compared to last year. Yeah.
Now, the other element of the US economic situation that we want to ask you about is their debt levels, because the story towards the back end of last year was that bond yields were actually going up even as the US Fed was cutting, and there's been a lot of concern about the US levels of US government debt. I think as a line item now, interest payments are the fourth biggest item on the US government's budget. So how do you think about that, especially as a multi-asset investor and you're thinking about your fixed income allocations? How do you think about the risk in US government debt?
First of all, we don't like the back end of US bonds for that reason. So higher fiscal deficits usually leads to higher bond yields. Even high growth and inflation we discussed means higher long-end bond yields. So we're staying away from the back end of the curve, first and foremost. But I think the interesting part about that is what is the limit to government spending? We made the case earlier about fiscal stimulus being an imperative, doing all these supply chain shifts, et cetera, spending more in defense. All those things need to be done. When does the market sort of pull you back in order? Like when's the Liz Truss moments happen in the UK, right? When does that happen to the US? Now, it's hard to say when you're the world's reserve currency, most liquid global bond market. You have buyers that have to hold your bonds, there's nowhere else to put them. Harder to say there, but naturally higher interest rates, higher back-end curves, I should say. When is it unsustainable? Hard to say. There's the famous Reinhardt-Rogoff model that turned out to be the most expensive spreadsheet error of all time. They forgot to drag down a formula. And that was the entire basis of European austerity. So again.
Oh my God.
Really?
Most expensive spreadsheet error in history. So that, because that's been discredited, no one knows when the natural limit of spending is. What debt to GDP level is too high.
Wow.
Famously, JFK asked James Tobin, famous for many things, but Tobin's Cube being one of them, what is the actual limit to fiscal spending? And his response was inflation. So you can keep on spending until inflation gets too high. Now, if you do have that moment where bond yields back up, what can governments do? Well, you can buy your bonds back. So you can do QE, yield curve control. Those are some things you can do. So I guess the worst case scenario is, according to current budget forecasts, 2053 debt to GDP in the US, 200%. If you have yield curve control, let's say the Fed buys all the bonds, that just puts you where we are right now in Japan. Their bond market, 230% debt to GDP. BOJ owns 50%, if not more, of the JGB's outstanding. So that's the worst case scenario. That's not Venezuela. That's not having riots in the streets. That's just probably low growth and stagnant activity. So no one knows. But for us, stay away from the long end of the curve, prefer inflation-linked bonds, prefer other countries to buy our duration risk in, to answer your question.
Yeah. Now, Seb, before we move to how this all translates to actually investing and creating portfolios, how do you see the macro landscape here in Australia? We've just had a reduction in interest rates, which everyone's pretty happy about. But what's your sort of longer-term view?
So same to the rest of the world, so stumbling out of a slowdown. So think about our GDP, let's call it around numbers, 1% last year, which is pretty weak. It's the worst since, if you take COVID out, it's the worst since the 1991 recession. If you include per capita, so take immigration out of the equation, it was minus 1.45. So very, very weak growth, led mainly by government spending. So immigration plus tax cuts, subsidies, infrastructure spend helped keep growth afloat, but pretty weak. Now that's improving. You've had a rate cut come through. You're seeing spending increase. You're seeing household spending on discretionary improve. You're seeing business loans pick up. So again, there's a business cycle starting again. So it's improving. Things are looking pretty good. A few rate cuts come through. Economy looking relatively okay. We expect growth to be around trend this year. So without any tariffs coming our way, because we're not Europe or Japan, we should be able to recover quite nicely here.
Nice.
Good.
That's
And
some.
then there's house prices.
Yeah. So, Seb, you run multi-asset portfolios, and we want to unpack a number of elements there. But let's just start by defining, like, what is multi-asset investing?
Good question. So I guess for us, our objective is to deliver sort of absolute returns over a market cycle. So deliver positive returns, usually with lower risk and lower volatility than other asset classes or funds. But it's quite different from, say, an equity manager. Their job is to pick the best stocks and outperform a benchmark. Ours is to deliver you an absolute return through a cycle. And we do that by investing in everything. So we can buy equities, government bonds, corporate credits, currency, commodities, alternatives, you name it. We're trying to deliver a return throughout the cycle. So to give you an example, of one of the main funds I run, Schroders Real Return Fund, that is on offer as an ETF on the ASX. It's called GROW, G-R-O-W. That objective is to give you CPI plus 4 to 5% returns. So again, inflation-linked returns with lower volatility and lower drawdown. Now, how do we do that? Again, we allocate to different asset classes and different asset prices throughout the cycle. So we have to think about every day, what is the best forward-looking risk return for each asset class and allocate accordingly. Now, I can go through our process in lots of detail, but I don't want to put your listeners to sleep. So I guess if you dial it down to or distill it to a very simple strategy, we call what we do the VCL framework. So value, cycle, and liquidity. So value, terrible timing tool, but it gives you an understanding of where opportunities lie or where the risks lie. So how much equities do you want to have if they're very expensive or very cheap? Even within asset classes, relative value opportunities, does this currency look cheaper than another currency? You can do a pair trade there. So value is very important, but terrible timing tool. Understanding the cycle is quite important. We talked briefly about inflation, what we see US growth compared to European growth, et cetera. That tells you where to invest, but also tells you how much risk to take. So if you're heading into recession, you shouldn't be dialing up your risk. You should be paring it back. If you're heading into recovery phase, go all in. It also tells you where to take your risk. Should you be in small caps right now if you're at the start of a cycle, or should you be tilting towards quality companies if you're heading towards a slowdown? So how much risk to take, where to take your risk, and what type of asset classes to hold is very important in that cycle component. And then finally, L, liquidity, sort of a catch-all, monetary policy, fiscal policy, sentiment, positioning. That helps you with the shorter-term timing. Like maybe a market's very expensive, like right now, for example, in the US, very expensive, very positive cycle, but everyone's all in and very, very exuberant. You might want to take a bit off the table, wait for a pullback in positioning, then reallocate again. So VCL brings a big picture, 10-year view of valuations down to a daily view of where people are positioned, and that's how we allocate between asset classes and portfolios.
And so then in terms of portfolio construction, can you help illustrate how that all comes together?
Sure. So, again, I said that was part of the process. We have expected returns. We look at forward-looking expected returns. We look at probability of loss, which I think is important because rather than saying volatility spikes, probably the best time to buy. That's when probability of loss falls. When volatility is low, people are complacent. So optimize the portfolio to maximize your return, limit probability of loss, but try and get a robust portfolio that's diversified across multiple asset classes to minimize that volatility. And because we're always moving the portfolio around, depending on our view, depending on the cycle, hopefully we avoid those drawdowns and then lever into the upturns when they occur. So every day can look different, but ultimately we do use cash as a buffer sometimes to either defend the portfolio or to spend, to go aggressive. But right now, for example, we probably have around 40-ish plus % in equities, mainly US equities, a large chunk in different types of credit markets, and some commodities and different currencies helping insulate the portfolio.
And then how often are you rebalancing or changing your asset allocation? Like you've said daily a few times there, but I assume it's not a daily process.
No, so I don't want to give the idea that we day trade, right? No. That's a terrible thing to do. Unless you're good at it, in which case go for gold. But for us, our process is here's our view. If the market oscillates wildly around that, we can profit. So just to give you an example, again, using that fund as an example, we were very bullish on Australian government bonds. At the time, if you look at futures market, the first rate cut was expected to be in August, only 1.5 rate cuts this year. We thought that's underpriced. So we bought a lot of front-end Aussie bonds, 3-year futures, for example. They're more tied to interest rates. That then jumped forward to more recently after the inflation print to being a cut in February is 93% chance, and 4 rate cuts were priced for this year. We went, well, that's done. That's more than we expect. Let's take profit and move on. So we made money on our view. Our view hasn't changed. In fact, it came true almost, but we profited before it even came to be a reality because the rate cut was only a few days ago. So as the market moves around your view, you can profit. More structurally, though, when you have big turning points, that's when you do the big calls. So again, using the real return fund example or grow as an example, we were very bearish at the end of 2021. So think about why. Valuations were stretched. The cycle was turning. We have a top-down earnings model in the US that showed earnings collapsing in 2022 from a standpoint of being in 2021. Our cash rate model suggested 5% cash rates. I thought it was broken, turned out to be 100% correct. And Powell was telling you, I'm going to hike and I'm going to do QT. So we de-risked aggressively. We raised cash to around close to 50% of the fund. Now, the reason we did that is because within inflation environments, we discussed our inflation views. We're talking about that for years now. You don't want to hold bonds to offset your equity risk. You need cash, you need commodities, you need US dollars. So that really insulated the portfolio. Our drawdown during that time was about 1/3 of equities and bonds. If we had a 60-40, we'd down like 30%. We're only down like 13 at the time. So having that dynamic asset allocation really helped us. Now, getting out's one thing, getting back in is the other part, right? So jump forward to September, we're saying, okay, our inflation forward-looking indicators are rolling off, knocked back to 2%, but the peak is in. Cash rates were pricing in a 5% terminal rate already, so tick that box. And we thought, okay, during a recession or during an inflationary period, P is good to say 14, 15 times, earnings recession down 15 times, never happens at the same time. Let's call it 15 down on earnings, 16 PE. That gets to the 3,400 on the S&P. During September, we got to 3,500, close enough tick. Then the market rebounded 3,600. Okay, a nice return there. We'll start to invest. We bought back lots of equities and bonds, credit, I should say, got rid of our cash, September, October 22, and that was the bottom.
Yeah.
So again, using that dynamic asset allocation, using that VCL framework, getting out in time, getting back in time. That's not going to happen every day.
Yeah, I was going to say, you've nailed the timing on both ends there.
Those are the big picture things you want to get right. When you can't get to your returns because the market's collapsing, defend your downside. More normal environments, more like that RBA example I gave, finding opportunities, finding mispricings and profiting from them as volatility is back again. Our process works really well in this new environment, or should I say, the more normal environment post the GFC anomaly.
So I'm interested in that process there, because the way you've just described it, you made it just seem like it was just obvious. It was like, you had all these indicators in 2021 and it was time to get out. But like, I think if people go put their minds back in 2021, like a lot of like investment banks and like, Wall Street, they weren't saying, all right, it's time to get out. They were saying like, this is as good as it's going to get. And, that things are going to the moon. And, it wasn't just idiots like us on podcasts saying things are good. It was like the biggest institutions in the world. Yeah. And on the flip side, if you go to October 2022, that was kind of when a lot of people were just waking up and realizing like, oh, there's a lot of pain here. Yeah. And there was a lot of predictions that there was heaps more pain to come. So are you purely looking at like your internal models and metrics, or like how do you clear out all that noise that surrounds the financial industry?
Well, it's having a process first and foremost. Like you have a rigorous process that you trust. You've been doing it for years. I mean, this process was invented before the GFC, so it probably worked better pre-GFC than during the post-GFC period. But now it's working again because you got volatility and inflation back. Understanding the cycle is extremely important. Understanding valuations and that probability of loss metric I mentioned is very important. Now, to answer your question, I think you answered your own question. If everyone's saying to the moon, that's a pretty clear signal that you should start to de-risk. Mm-hmm. We were saying recession's coming. Obviously, it didn't happen in the end of the day, but we were saying that at the very end of 21, start of 22, everyone laughed at us until they all agreed with us. And that was also a very interesting buy signal, because when everyone's panicking, everyone thinks they're de-risking. That's usually the bottom. Mm-hmm. That's why having that final part, liquidity, sentiment, positioning, really helps you understand where you are. And that was a clear washout in positioning and sentiment at that time. Now, the other thing we don't talk about much is there was a banking crisis, not a banking crisis, the pension crisis in the UK occurred around that time as well. and you saw some metrics of liquidity improve around the world. So central banks weren't saying we're taking our foot off the brake, but the underlying dynamics of money showed you that somewhere people were actually putting money back into the system to prevent that occurring in, say, the US. So liquidity was improving, positioning was all washed out. We got to our buy target. We also had our earnings model pick up again. And because we work at a global firm, we could pick up the phone, talk to our global head of equities, saying, what are you seeing from the bottom up? Are there any signs in corporate earnings that a recession is coming? And they were saying, no, everything looks great. So our macro models plus his insight from the bottom up helped us get confidence that then was a time to reinvest and buy.
So you've nailed the timing in 2021 and in late 2022. And so the obvious question is, how are you positioning it today? I think earlier you said you're in 40% US equities. So you're not taking your chips off the table right now.
No.
So, I mean, we can do sophisticated things in the portfolio. So right now, for example, our macro case is very strong in the US. I mentioned that already.
Yeah.
Valuation's a stretch. We can debate that a bit later. But sentiment is very strong. Positioning is very strong. So that could be right. But typically, there's a pullback. And everyone's pricing in all the good things about Trump. Everyone's forgotten that he's actually going to go to, do reciprocal tariffs on everyone. That could start something. So for us, we think now is time to put some protection in place. We can buy put options. I don't want to scare your listeners. Options sound scary, but effectively, it's insurance. And it's very, very cheap to buy that right now. So if you have a discount on your insurance for your house, you probably go and buy it, right? So we have put options in the fund, 10% of the fund. If the market falls, we're naturally protected because of that. So finding opportunities when they are attractive to us, that's what we have. Now we have sold some credit to raise cash. If you have a pullback, we can redeploy that cash into equities based on our view. But right now we're sitting there with a bit of protection on and a bit of cash buffer just in case we get some wobbles along the way.
Now, Seb, you have a couple of listed ETFs. You've got ALF, ALPH, listed on the ASX, and then HIGH, listed on CBOE. HIGH is your high-yielding credit fund, and Alpha is your equity alpha active ETF. Mm-hmm. What are your, views on the specific asset classes there, and where are they in the cycle?
I guess, from my job, top-down multi-asset, we try and see where do you want to allocate to. So based on our views, again, those are two different teams, so I'm not, plugging my fund. Our views on equities is that we do believe equities is the place to be, higher growth, higher inflation, better for equities. So equities is our preferred asset class. Within that, we discussed US equities, so call it we prefer global over Aussie. Yes, US is expensive, but obviously you have the Mag 7 in there, but Australia's not cheap either. I mean, we're the third most expensive country, US, India, than us. CBA-P's ratio is higher than Google's. Yeah. So is Google expensive or is CBA expensive? European banks are around 10 times P ratio, right? So expensive, yes, but there's a reason why it's expensive. We believe you should start to take some chips off the table of the Mag 7 because there's going to be winners and losers, right? When DeepSeek came out, NVIDIA got hit, Microsoft got hit, but Google, Apple, and Meta rose on the day. So there's no more everyone wins in this AI race. There's winners and losers. So we think moving away from passive towards active makes sense. So we actually had more passive allocation to US equities. Now we're using our internal team, the fund you mentioned, having that active allocation to pick the winners and losers. Overweight and underweight some of those Mag 7, allocating to banks in the US, for example, because they're doing well, or should do well under the Trump administration, buying more industrials that have links to those industrial policies. So being more active, finding the best stocks in that universe is quite attractive to us. And we thought it was so attractive, we'd list it to everyone else to invest in. So we listed that in Australia. The track record is more than 20 years old, but being offered in Australia only recently. ETF, as you mentioned, is ALF, ALPH on ASX. That was listed a few weeks ago, but now it's being sort of hard launched today. So we quite like that as an asset class. When it comes to other asset classes, I joke we like US equities over Aussie equities. When it comes to government bonds and credit, we like Australian bonds as opposed to US bonds. Focusing on credit, spreads, which is how much you get paid above government bonds and corporates, is how you determine if it's cheap or expensive. Spreads in the US are extremely, extremely tight. So you're getting paid next to nothing to hold that risk. To put in perspective, US high yield spreads are in the second percentile. So they've only been tighter since the 90s, 2% of the time. So I'm not suggesting they're going to widen, but it's very, very thin and not getting paid much to take that risk. US investment grade is about 6th percentile. So not as bad, but let's call it extremely expensive. Australia spreads are relatively wider. So they're around the 30th percentile now in terms of their own history. And in absolute spreads, you're getting paid more in Aussie credit than in US credit, despite us having 2 rating notches higher, so safer, than their index. I'd love to get paid more for less risk. So we really like Australian credit as an asset class.
That's interesting that we're 2 ratings notches higher than US credit. I just would have thought, like you think about the big US corporates, like they would have been as investment grade as you get, but no.
Well, they issued lots of, it makes sense for companies to issue further down the credit spectrum, not in high yield, but say triple Bs, to optimize how much you're paying versus how much conditions you have in the debt offering. So sometimes companies like to issue further down the credit spectrum. Australia is dominated by high quality banks effectively. So we have a higher credit rating there. So while the overall index is higher quality and higher yielding, I should say higher spread right now than the US, within that space, there are interesting components. So most of it's banks, but you can buy sub-debt, which is effectively, tier 2s in banks, higher yield, but not sub-investment grade. A- credit rating there, significantly higher yields than, say, the standardized corporates or banks. Within the corporate space as well, going down into that triple B space isn't well represented in the index. Those are your infrastructure companies, your utility companies, still very high quality companies, but they're paying a higher yield because they do have more debt because they're, those type of companies. The good thing about them, though, their earnings are inflation protected. So talk about inflation, I'd much rather have a company that's an energy producer or an energy transmitter that can pass those costs on to consumers, and they're paying me more to do that. It's a great investment. So what we've recently done, we've had a fund for over 20 years that picks those sub-debt, the tier 2s and banks, and also that triple B space to give you a higher yield than the average Aussie credit index. We call that the Australia Higher Yielding Credit Fund. It's not high yield, it's not sub-investment grade, but it's yielding around 6.5, say, right now, and it's all investment grade. So we like that. We allocate that in our portfolio and our multi-asset funds. But again, we've now listed that on SIBO, and that ticker is high, HIGH. So higher yielding, but investment grade offering.
Yeah, so you've got 2 active ETFs on SIBO. You've got PAYS and High, and then you've got ALF, which Bryce mentioned earlier, and then you've got Grow, which is also on the ASX. So it seems like active ETFs are part of the Schroders strategy moving forward. It also feels like you guys have secured a lot of the good tickets.
Yeah, I was thinking that. How did you get?
When I first saw Grow, I was like, you guys did well there. Yeah. So is active ETFs, is that a big part of the focus moving forward?
Well, our focus is always obviously just creating great funds that we sell to our clients. So we have our whole unlisted suite that's still there. Everyone can buy those funds and they're high quality active funds. But we thought another way to access these funds is active ETFs. Now Grow, we had first mover advantage. I think we launched that in 2016. So it was easier to get. PAYS, which is similar to the real return fund. I mentioned the top-down asset allocation, all the dynamicism we use, but this is a income-only version. So no equities, no commodities, just income stocks. Better for a retiree or someone approaching retirement.
Oh, so it's income stocks as well as credit.
Not income stocks, income allocation.
Yeah.
Sorry, my mistake. So you've got the higher octane equities multi-asset fund, then the no equity PAYS, high quality income, downside protection. Then we have the 2 other strategies you mentioned. One is global equities, alpha. The other one is high yielding credit pool. So we've got those 4 already. We're probably going to launch more this year, so watch the space.
Nice.
Hopefully ticker is just as exciting.
I know. You've set the bar pretty high.
We've got one under wraps, which is pretty good. So it's going to continue the trend of having nice words that are our tickers. But, we're very dedicated to the space, and we're hoping to bring our products to more and more people out there.
Love it. Well, Seb, that brings us to the end today. Takeaway from today, volatility equals opportunity. A lot to keep an eye on this year as we're only 3 weeks into Trump, so who knows what's going to play out. But thank you so much for coming in and sharing your thoughts today with us. We really appreciate it.
Great. Thanks, Bryce. Thanks, Alex. Thanks for having me.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.